Welcome to the module on Statutory Audit. Learning objectives. Understand the purpose of a statutory audit. Explain the legal framework related to statutory audit. Articulate significance of statutory audit to the stakeholders. Infer the inherent limitations of a statutory audit. An external audit is a type of assurance engagement that is carried out by an auditor to give an independent opinion on a set of financial statements. An external audit engagement helps the auditor to express an opinion on whether the financial statements are prepared in accordance with an applicable financial reporting framework or not. The main reason for the requirement of statutory audit is because of the fact that the ownership and management of a company are not necessarily one and the same. In many countries, external audits are required under national law passed by the legislative bodies, or national statute. Hence, they are termed as statutory audits. The International Auditing and Assurance Standards Board, that is, IAASB, International Framework for Assurance Engagements, provides a frame of reference for professional accountants when performing statutory audits. The various parties interested in the accounts of a company are sometimes referred to as stakeholders. They are directors, employees, shareholders, creditors, taxation authorities, and the public. A statutory audit provides assurance to the shareholders and other stakeholders of a company on the financial statements because it is independent and impartial. Although they will each judge the accounts by different criteria, they will be benefited from this assurance that the accounts they are reading have been subject to an independent report. The auditor's report on company financial statements is expressed in terms of truth and fairness. The auditor's report does not guarantee that the financial statements are correct, but that they are true and fair within a reasonable margin of error. True and fair are not defined in law or audit guidance, but the following definitions are generally accepted. True information is factual and conforms with reality. In addition, the information conforms with the required standards and law. The financial statements have been correctly extracted from the books and records. Fair information is free from discrimination and bias, and is in compliance with expected standards and rules. The accounts should reflect the commercial substance of the company's underlying transactions. One of the reasons that an auditor does not give absolute assurance is because of the inherent limitations of the audit. Misstatements, which are significant to the stakeholders, may exist in financial statements. The auditors will plan their work keeping the concept of materiality in mind. Materiality is an expression of the relative importance of a particular matter in the context of the financial statements as a whole. A matter is material if its omission or misstatement would reasonably be expected to influence the economic decisions of the users taken on the basis of the financial statements. In this video, we recognize the purpose of a statutory audit and the related legal framework. We also identified the stakeholders who have an interest in the outcome of statutory audits. We also understood the concept of materiality while recognizing the inherent limitations of a statutory audit.